Hey y'all, Seth June here with Seth June and Associates Real Estate, and today I have with me Anna Louise with Neighborhood Loans. She is your expert mortgage loan officer and your go-to contact for anything lending. Today we're going to talk a little bit about common buyer mistakes. We see it all too often, and my first question for Anna is, what are some of the most common financial mistakes buyers make during the loan application process?
So ultimately, clients want to avoid doing a handful of things. The first, you do not want to quit your job in the middle of a loan application. What many clients don't realize is at the end of the transaction, we actually verify that you're still actively employed, that you haven't put your 2 weeks notice in, that you didn't quit your job in the middle of the transaction after giving us pay stubs and W-2. So we make sure that you're still actively working. So unless you and your lender are aware that you're leaving your job, transferring to a new job, ultimately you want to make sure that you don't make any job changes without your loan officer knowing. Another thing is going to be in relation to taking out new debt. Granted, we pull your credit up front, but throughout the process, your credit's monitored. So anytime your credit's pulled or any changes are made to your credit report, we get a notice. So you want to make sure that you don't take out any new debt during the process, and you try to avoid any credit pulls as well. Now, granted, of course, when you're turning on power or shopping for insurance, sometimes you may have your credit pulled then, but ultimately those are not situations that are going to bother you. And then the third is going to be large purchases or large deposits from your bank account. So when we begin the process, we verify your assets and we see if you have enough money for down payment, if you have enough money for closing costs, depending on what your loan requires. But also we're going to see if you have any money in reserve. So if you have any money left in your account post-closing, that would cover upcoming monthly mortgage payments. And sometimes those monthly reserves can be really what saves your deal, what pushes your loan through to closing. So you want to be mindful of any large purchases that are going to take away funds from those reserves and could potentially put you in a position where you no longer qualify. Outside of that, you want to make sure that you don't take any sums of cash and deposit it into your bank account as well, because all assets within a 30-day to 60-day span have to be sourced in one way or another, depending on what loan product or loan type that you're going with. Each product has their own guidelines, some down to every dollar, some down to 50%. So you want to be mindful of deposits as well.
It's a lot of great information. So from the real estate side, we see these things as well, obviously, as we're involved in the transaction. And being a coastal city, we see folks make those job transfers. They're coming from out of state somewhere and moving to the coast, trying to enjoy life at the beach. How can they properly maneuver those job changes? Is it just by telling y'all up front, or how's that work?
For sure. You want to make sure that your lender has a true explanation of what your goals are with your move to South Carolina or North Carolina. So if you're planning on coming here and retiring, we need to know and we need to plan accordingly. If you're moving jobs and taking a new hourly position or salary position, we need to know and plan accordingly. If you're closing out a bank that is not local to the area and want to establish a new banking relationship here, we need to know that so we can plan accordingly, because what we're going to do is we're going to guide you with the correct documentation request that we would need to source that from our underwriting team. You know, the loan officer, we build the relationship with the clients up front, but ultimately the file gets passed from not only myself, but to our underwriting team as well. So we want to be able to present them with the full picture to make sure that we can get your file closed as quick and easily as possible.
So also we've seen people, what they think may be an innocent purchase, such as they want to go ahead and put a down payment or buy their furniture up front prior to closing. We've seen this kill deals before.
Yeah.
What are some key updates that buyers should reach out and update you about?
For sure. So when we do your application, we're going to go over with you, this is what your credit looks like right now. These are the liabilities that are reporting on your credit report. This is what we've got showing for your income. Is this correct? So we're going to break it down every step. If at any point in that process you co-sign for someone, you sign up for a new credit card, you decide to finance a new car, whatever the case may be, we need to be updated, because at that point your file has changed. And for some clients, it may not be enough to impact their file and they're good to move forward, and we would just need to gather some updated documentation. But for others, it could change the entire structure of their loan, what loan product they're approved for, or even if they're approved at all. So before you make any big credit, asset, income decisions while you're in the middle of working through your loan, make sure you talk to your lender. And along with that, you want to make sure that any debt that you had at the time of applying for your loan, that you're actively making payments on those debts on time too. Because what a lot of people don't realize is with your credit being monitored throughout the process, we can also see if a new late payment reports as well. So you definitely want to make sure that you stay on top of any liabilities that you have in your name throughout the loan application, so that doesn't result in a drop in credit score and again impact your approval odds.
For sure. So more communication, the better, obviously,
Absolutely.
throughout the process if you want a clean experience.
Absolutely. And ultimately, it's our job to help you plan for the future. So if a circumstance comes up where you want to apply for a credit card to save money on appliances, or you're needing a new vehicle, let us know up front so we can let you know how that would potentially impact your loan, and ultimately how it could affect something like your debt to income ratios as well. We're here to help you. We're here to aid you. So look at us as a tool, as a friend, throughout this process, so we can help get you through the finish line.
Awesome. Can you please explain the impact of not reviewing the loan documents carefully and missing any deadlines during the application process?
For sure. So while we're walking through the application, we'll do your initial application, then we'll move from there to processing, from there to underwriting. And then once underwriting takes a look at the file, they'll let us know any updated documentation that they need based off of any questions that they have. So once we make it through that initial underwrite, we're going to reach out to you and say, hey, we need XYZ. Looks like we need additional bank statements. Looks like we need an extra 2 weeks pay stubs, or hey, looks like you're taking a new job. We need to make sure you have an offer letter and we can see any pre-employment contingencies were met. So when we send out that update to you, we're going to let you know through email. We're going to let you know through phone call. We're going to let you know through text. We're going to make sure that you see it. And we like to put a time frame there with the client so they have realistic expectations of, to get your loan closed on time, I need this document by this date. Because not only does the transaction depend on, our underwriting team looking at it, but we got to make sure that we get your file to the closer in time once you're clear to close, and that the attorney gets your package on time once the closer has sent out the package. There's so many things, so many dates that one relies on the other. So to stay on top of the documentation that's needed, and be mindful of the dates that we give when we ask for documentation, it does play a huge role in how quick and easy and seamlessly the process can go by.
Perfect. What exactly are mortgage points, and how do they affect the borrower's loan?
Absolutely. So mortgage points are going to be what it costs the borrower to lock into their rate. Now, this can go in one of two ways. It could be for the client to buy their rate down, or it could simply just be the only way that the client can lock into their loan, whether it be risk or in some cases reward. So ultimately, a client, when they go to lock in their interest rate, they're going to be presented with the option of, hey, this is your par pricing, which means it costs you nothing to lock in your rate, or this is what your option would be to buy down by a half a point, 2 points. So a point is based off of your loan amount. 1 point is 1% of your loan. That doesn't mean it's going to come off your rate 1 point, so you wouldn't leave a 6.5% rate to get to a 5.5% rate, but it gives the client the opportunity to either buy down their rate, or depending on how risky the file is, it may put the client in a position where they have to pay points to lock no matter what. There's no par option.
Awesome. And how should a borrower decide whether they should buy points, if that's the right choice for them?
So if they're in a position where they can buy their rate down further and they want to move forward with pricing that is not par, ultimately what they'll want to do is take a look at how much it costs them to buy that rate down up front, whether it's a point or 2 points, if they've got a seller credit that's covering that rate buy down, and then look at how much in monthly savings they're going to build up in comparison to what that par pricing may be. So if it's going to take them 3 to 4 years to build back in monthly savings what it costs them up front, and they're really planning on only having the home a year to two, then it may not be in their best interest to buy down the rate. The other side of that is if you've got someone that's looking at, maybe this is their forever home and they really want to be in a specific range for monthly payment, oftentimes clients are in a better position to buy down the rate than they are to put extra money down because it saves them more money at once.
How does the outcome of an appraisal directly affect the terms of a mortgage loan?
For sure. So an appraisal is one of the key pieces of getting a loan through processing, underwriting, and then ultimately us being able to market as clear to close. There are some circumstances where a file is so strong that we would have something that's called an appraisal waiver, so where the client would not have to have an appraisal done on the property unless they wanted one, but ultimately that is case by case, file by file, home by home. So there's no way to know up front if you're going to qualify for an appraisal waiver on that property until you're under contract. But once the appraisal's ordered, we need essentially for the appraiser to confirm that what you're paying for the home, that the home's worth that. The buyer themselves, they're the owner of that report. They pay for it. So if a property were to over appraise by $10,000 or $15,000, the seller does not know, it doesn't change anything with your purchase price. You just have the awesome feeling of knowing that you're walking into a home with some additional equity. The flip side of that is if a property were to underappraise, then we have certain challenges that come forward that we have to work around. The other part with an appraisal too is an appraiser is going to go out and they're going to make sure that that property is up to standard based off of whatever loan product that client's moving forward with, whether it be FHA, conventional, VA. Every single loan product has their own requirement in terms of an appraisal, what they're looking for, whether it be hand railings on stairs or flooring down in a home. Every single appraisal report is going to be different based off of what appraiser is assigned and what loan product is assigned to that file. So depending on how those come back, you could have some conditions with your appraisal.
For sure. And there's multiple type loans out there, and like she said, all of them may have different requirements for that type of appraisal. You did mention that if an appraisal comes in below the purchase price, that there may be some things we have to do from the lending side. What would you recommend the buyer do at that point if the appraisal does come in lower than what they're under contract at?
Yeah, so one of two things can happen. So the client can go to their agent and see about potentially trying to renegotiate, or the client can put more money down and make up the difference. They have the ability to do that too. And we have seen that done before. If it's a client that this is their dream home, they don't want to risk walking away from the property, you have the opportunity to do that. What you don't have the opportunity to do is close without making up that difference. So if the seller isn't willing to come in and lower the price and the buyer doesn't have or doesn't want to provide the extra funds to make up the difference, then we're at a standstill on the contract.
Common misunderstanding that we hear on the real estate side of things, and I'm sure y'all hear as well, is the actual difference in an inspection and an appraisal. And people think that they're the same thing. So we always try to, on the real estate side, is explain the difference. And that inspection is private. That's more for the buyer, more so than the lender. The appraiser comes in, does the appraisal, that's for your financing. The inspection is for your information. Do you want to ask the seller to possibly fix any issues that may come up? So that all is for you. That's all personal preference. It's for your information. This is an expense for you as the buyer yourself, just as the appraisal is for most loans, correct?
Correct. And I mean, with the appraisal, again, the appraiser is looking loan-based and loan requirement and making sure that the appraised value and the sales price, I guess, coincide, if you will. So ultimately, they're trying to confirm that the lender and the buyer are both making good investments, to whereas an inspection is going to look more so on the property as a whole, not just the contingency of the loan.
A lot of information, great information. If you have any questions, definitely reach out to Anna Louise. She's your go-to lender, licensed in North and South Carolina, and hopefully growing with us to Tennessee soon. Give us a call. My number is 843-504-2241.
And my number is 843-287-1174.
Thanks.